Hey everybody, it's Pete. I want to thank you so much for joining me today. I have a really fun video that I'd like to introduce you to. Every morning before the market opens, we have what we call in the boot camp our game plan meeting, and it usually starts around 8:30 in the morning. I'm going to give you about a 20-minute snippet here, and these are the kind of lessons, advanced trading lessons that can absolutely positively change everything for you if you take the lesson and actually use it. That's the big thing. Having the knowledge and actually applying it is a dramatic difference. We got pretty heated today. We got into some interesting topics, but one of the things that we talked about that was really fun is if you could imagine that you are trading and you have some losses, you have some wins, and you're kind of just like balancing that act between you're not losing money anymore, you're not really making any money, and there's that little bit of a difference that if you understood something differently, all of a sudden your account starts to go like this in the right direction, where you have the losses under control, but you understand how and when to trade bigger, and more importantly, how to do that. So enjoy this video. I really think you're going to like it. Watch it all the way through to the end, because we get into the real juicy part of it about 2/3 of the way through. And here's the thing I want to ask you to, though. First, number one is if you enjoy this kind of content and you want more of this, make sure you hit this. Make sure you hit the subscribe button. I would really like to make sure that you get updates and smash that like button. But number two, I want to introduce you to our 30-day boot camp. This is a small snippet. It's just one game plan meeting. We have these every single day before the market opens, and you get a ton of other stuff. It's basically a 30-day real-time seminar where you get my calls, my entries, my exits, my swing trades, my day trades, my coaching calls, plus a ton more. Click the link below the video and learn about everything you get. It's only $295 for 30 days. It's practically a steal. Watch the video, enjoy the video. Let me know if you have any comments, and I hope to see you on the other side in the boot camp. Take care now. All right, so we're going to hop into today. I think I want to start out. We were having a conversation this morning about some stocks that reported earnings and really aren't moving that much. We had noticed yesterday during the morning that there was a kind of a disconnect between the really super bullish environment in the market internals, but the market itself really wasn't bouncing. We actually did end up closing near the highs, which that kind of does validate the fact that there was a big disconnect. But I want to kind of tie that back to NEO. And it was a good question that was asked this morning. How do we, what does it mean if stocks are not reacting to news at all, specifically the earnings? And I'm obviously using NEO here as an example. Well, what it's telling me right now is that there's no selling. Normally after earnings, you get a really, I'm not going to say emotional, you get a very quick reaction to the numbers and the guidance and everything like that. And these stocks specifically have not had any significant price action, I think, since the end of June. But they didn't react in a negative way as well, which I think is pretty interesting. And obviously you can see NEO is actually up right now. So because of that, we start to put the pieces together and say what should have happened, what could have happened, what normally happens, and how do we interpret that? How do we turn that into a trade? The fact that they're not selling off, and NEO specifically because of earnings is not selling off, I'm leaning towards being a buyer in NEO today. And obviously I want to see it get out of this range here. And you can see the weekly chart with a bunch of melted candles for the last 4 weeks, basically for most of July. I'm looking to be a buyer today. So I am right now interpreting it as it's kind of the difference between it's not bearish, which is making me want to be a buyer, but I'm not necessarily bullish until we actually see a couple of days of buying. So I wanted to walk through my thought process. Jeremy asked a good question about that this morning and how do we interpret it, which is kind of what we were also saying about the market internals, that we kept seeing lower highs in the tick readings yesterday. And we were saying that's not good and that would need to change. And I think this is where we put it in there. Yeah, this was yesterday where the VIX was going down. The tick readings were mostly positive, but we were consistently seeing lower highs, which eventually did lead to a flush down in the market. So you can see this is as of 10:30 yesterday. And then when we looked at the market, we actually did end up hitting the bottom, right? We actually did end up pushing down from 10:30 into 11 o'clock, despite the fact that we were holding there. But then we actually saw the opposite. We started to see higher lows, and that ultimately led to this move to the upside. So we get, again, digging deeper into exactly what it means, but you can also start adding to the equation, what are we not seeing? And in this particular case here, we did not see selling in NEO after the earnings. So I'm interpreting that as good, even though it's not up as hard as some of the other stocks like PLTR, which a lot of people are talking about this morning, and where it is. I personally have traded PLTR quite a bit over the last, let's say, 3 or 4 months. I have not found it a stock that has repeatable order flow. Maybe it'll change after earnings. Obviously, this is a big move. It's all the way up here in the 2440s. I know we were joking around for a while that it couldn't get away from $25. Finally did. We had this trade on. It came right back in. We took a flat. It's one of those situations where I know that we make the distinction between day trading stocks, swing trading stocks, and investments. I personally have not found this stock to have attention on it on a regular basis to where I'd be like, all right, this stock should be in my list every day. For example, like eBay let's even take NEO in those stocks. They're in my list every day because they have consistent order flow. They have consistent large green or large red candlesticks for the most part. And this particular stock, I don't see that. I haven't experienced that. Maybe today's earnings will make that change. I don't know. But I want to keep bringing that up because I get a lot of good questions about which stocks to be trading. This stock has a catalyst today. This stock is most likely in play today. We'll see if we get follow through. Very similar to the stocks that we've been talking about, such as UPXT. And we gave that very detailed analysis of what to look for and how to trade that after earnings, which was using the opening price of the day that the earnings came out, which in this case here is 160, let's just call it 167, still above that level, but that's kind of the line in the sand. Triple D, same exact thing. What is the line in the sand? Earnings came out. That's the line in the sand. So as long as it's above that level, that's where we're going to be holding it. So we'll use that same scenario with PLTR today, wherever it ends up opening up here in this 2440 area. And we'll use that as the line in the sand to determine whether or not smart money is following up the bullish gap and how that trade can be made. Also want to talk about how that translates into position sizing. So I just mentioned PLTR, and in my experience trading the stock, it doesn't have consistent attention from the smart money. That doesn't mean you can't trade it. That just means that you need to alter how you interact with the stock and how you get in there with your position sizing. So for example, if we're talking about NEO or XPEV or any one of these, when the stock's in play, the bid-ask spread gets tighter. The trading at the bid-ask becomes a lot more frequent. There's not a big spread. There's plenty of shares at every level. So I could be more comfortable trading 3,000 shares of this stock versus a stock that does not have consistent attention. I probably don't even want 500 shares of the stock. So these are the kind of deeper insights that you need to know, quite honestly, because let's say we got a stock like NEO that's in play, and let's say it does start to get follow through and the liquidity's there, the volatility's there. And even if it's just for 2 days, let's just use that for an example. Or, a better example is this. Let's use this as an example where the stock was basically ferociously being bought for 5 days. AMD has plenty of liquidity. The side of the trade was very obvious. It was going up day after day after day. You could easily, in this stock, get in there with 1,000, 2,000 shares and make your quarter because you recognize that there is liquidity. Other stocks that don't normally have that same kind of liquidity that trade very well when they are in play, such as OSTK, which we haven't called out in a while, when it is in play, you tend to trade less shares for that same dollar amount of move. So I guess I'm bringing this up because this is one of the things that I wrote down on my notes when I was traveling, was really going into deeper insights into, we spend a lot of time about not sizing up. I want to make sure that we spend just as much time on when we should size up. And I think AMD is probably the best example of that, where we call out trades and we'll get comments about how did you do? And we talk about points, but certain situations where everything is lining up, you should have more share size because there's attention on it and because there's liquidity. So I think we're going to, especially in the morning, in the first 90 minutes, spend a lot more time talking about sizing up when the situation calls for it. If the market's obvious, if the internals are obvious, if the sector is obvious, all of those kind of things. Because I don't think it's talked about enough, where 1 week of good price action could lead to making enough money for the month, quite frankly. So there are distinctions between trade setups that call for bigger share size. And I'll give this even a little bit more depth to where, let's say for argument's sake, and obviously the last 2 days, probably not the best example, but probably not the best example because we're pulling back here and we're actually long the swing trade. But this is important. This is really, really important. So let's say we're trading in here and we're calling out entries and we have all of those criteria. It's vicious to the upside. Clearly, many, many more green prints on the offer, and anybody, whoever we want to say, smart money is buying it. You can go in there comfortably, and I'm just using numbers. So everybody, these numbers will be different for everybody. And this is literally what I'll be doing. You'll go in there with, let's say, 2,000 shares to buy. And you get the inside 5-minute candlestick or the opening range breakout, and you're comfortable with it. But let's say that's getting out of your comfort zone a little bit, but the idea it checks off all the boxes. You'll go in there with 2,000 shares, but at the same time that you put in that 2,000 shares, you put in a stop loss for 1,000 shares at some level that you're like, all right, I'm in here with size. If this thing works out, it's going to be a home run. If it doesn't work out, I'm going to reduce my position size, but I still like the idea. So whether that's the low of the inside 5-minute candlestick or whether it's even 10 cents away, quite honestly, you're not risking more, but you're accepting and going after a bigger profit if the trade works out. Because I'm sure every single one of us on this call right now can recall a few of these trades that when they went, they freaking exploded for $3, $4, $5 in that first 45 minutes of the day. And if you use this position sizing strategy, there's been plenty of opportunity where if you have 2,000 shares, that sucker moves $3 in the first half hour, and now you're up $5,000 at 10:15 in the morning instead of being up 320. So these are the deeper insights into the other side of trade management, where when it's there, don't be afraid to go with more size, but be smart and have an out on partial shares if you don't get that immediate move in your favor. So I guess I want to throw it out to the community right now. Does everybody understand the context of what I'm talking about there? I am specifically talking about day trading. I want to make that clear. I'm specifically talking about getting out of your comfort zone with a bigger position sizing if the position and the setup is perfect, for lack of a better way of putting it, and understanding that we are going bigger, but also instantly putting in a stop loss if we don't get that incredible follow through. So I want to make sure that we are contextually understanding what I'm saying, because there's going to be a few, well, I put it on, but I didn't put the scale out stop loss on there. It's critical that you do both of those. So I want to make it clear. This is literally how bigger traders make bigger money. It's we talk about 3-to-1 reward and that kind of stuff, and that's obviously what we want to shoot for all the time. But I want to make it super clear, especially in this day and age where we're practically paying zero in commissions, practically, right? If you put that order out there and it moves, you have a home run that could pay for the week. If you put the order on and it doesn't do what you said, and I'm just going to use round numbers, even if it's 1,000 shares, you put on 1,000 shares, and actually we have a great example from last week, which was an absolute grand slam from last week, okay? You put on the shares and you have that, I love the idea, but if it doesn't go in my favor within a certain dollar amount, I'm just going to scale back, but I'm just going to still like the idea, okay? So the one trade that was a monster trade from last week was BTBT, and it was here. So I know Aldo's been talking about this stock. I know Jeremy's been talking about this stock. And it was this inside candlestick breakout on this day here, which was August 4th. I think it was last Wednesday. It literally, I think we got long at $11 and it traded up to 13. The stock had amazing liquidity. It was volatile on that day. That was a day where you could have implemented this strategy in a monster way. And I did, quite honestly, that day we were trading it, where it was very easy to have 3, 4, 5,000 shares of that stock. And if it moves in your favor, home run. The thing moved up. I mean, it was moving up 50 cents, pulling back 25, moving up 50 cents, pulling back. But position sizing and scaling back versus getting out is an advanced topic that I think that is probably overdue that we talk about. And yeah, Chris, that's a great example of it as well. And I think breakouts get a bad rap because they don't follow through enough. But that's a great example where, let's say you have an opening range breakout trade. I'm using this one as an example because we were in it that day. We were trading it pretty aggressively that day, actually. A breakout strategy or an opening range breakout strategy is a perfect example of that, or an inside 5-minute candlestick breakout. Just get out of your comfort zone. If it's above the open, above the hour, above the previous day's high, and all of those. Yeah, exactly. NVAX, that was a good one. I remember you called that one out. It pulled back, but the actual breakout of the opening range here, 244 to 250, that's a $6 move. Now, again, this is a $248 stock. That's not really the point. The point is we're talking about you put on the size at the right moment. It never pulls back, moves $2, $3, $4 in your favor immediately. And again, we were talking about yesterday scaling out of some of them, based on a big dollar amount, which is different for everybody. But if you have 1,000 shares of let's use a $20 stock, when you normally would take 300, and you're like, okay, if this moves in my favor, I have 1,000. If it moves against me, I'll quickly scale back 700 and ride the balance for what I would normally do. And you're not really taking on extra risk because you're immediately planning for what you're going to do in both sides of the trade. It's a position sizing strategy based on the quality of the idea and fully being aware that you can pull back on the share size as a part of the strategy, not because you're scared, but because you're looking for follow through. If you get follow, and Chris, this is a great example because this is a $6 move in a heartbeat. Even if it's $5, it's a $5 move in one 5-minute candlestick. Even if you have 500 shares of the stock, whatever, it doesn't matter how many shares, but let's use 500 as an example. That's a $2,500 move in 5 minutes because you were comfortable sizing up. Maybe normally would have taken 100 shares of the stock. So I want us as a community to have more of these types of conversations because this is what real trading is about. This is what real prop trading is about. This is what real professional trading is about. I spend a lot of time trying to keep everybody aware of the situations that are lower probability, but less than perfect, but still valid. Now I think that we're okay with talking about scenarios where everything is perfect and it's okay to get out of the comfort zone. And Chris brought up, that's a perfect scenario. I wasn't even thinking about a breakout trade. And the fact that I'm doing it every day and maybe not verbalizing it enough, we could probably talk about some of these scenarios. And if you think about it from a risk perspective, you're not really risking more as long as you put in that fail-safe stop loss of, okay, even if it's 10 cents, 15 cents, whatever the number is, depending on the volatility of the stock, you get in there and you're like, okay, I'm getting 1,000 shares of this thing. If it works out, great. It could be up $1,000 in the next 15 minutes. If it doesn't, I take a smaller loss but still have what would normally be the share size I would normally be comfortable with. So what I want to do is expand the consciousness of what we're looking for in those types of situations and make sure that we capitalize on those, because I think that win-loss percentage gets far too much publicity, and we can disprove that win-loss percentage matters in a big way simply by understanding 1 or 2 good trades a week with the right share size could make the entire week. And the rest of the week, these chopping back and forth and slow and melted candles, and none of that will matter. If you're up $4,000 by Thursday, and again, we talked about this yesterday morning, it doesn't matter which of the 10 trades made money. What matters is your net profitable $4,000. That's real trading. That's the direction our community is going in. And we're kind of weeding out the questions now about the perfect inside 5-minute candlestick, because none of that matters. What matters is the ideas and how we manage them. Okay. So, again, Andrew, very good point here that you're doing the same thing on the swings. And quite honestly, working the orders is kind of like the super secret part of trading that's the skill, right? The first part, which I think we're really good at, is finding the order flow. Making money is the actual trade management of it, which is both how long do you hold it and how much share size. And we talk a lot about the reward part of it. Now we're talking about, if you put on more size, planning to take some of it off if it doesn't work, and then having a home run if it does. But I think really more it's the mental part of it, allowing yourself to say, I'm going in bigger because it warrants it. If it doesn't follow through, I have a fail safe to get out 15 cents later below where I got in. And I'm okay with that because that's my normal share size anyway to a normal stop loss. And I think it's going to be exciting to have these conversations in individual stocks because there's been plenty of them that have exploded. Again, though, just full context, we have to make sure that we have that fail safe stop. Maybe we'll even start to, what is that? Fail safe stop, FSS. Maybe we'll start calling it the FSS on a particular idea.